Welcome to the Active Allocator Insight Series. We hope that educational presentations such as this one will further your understanding of asset allocation and portfolio construction. In this video, we illustrate how Active Allocator can be a great way to help you create both market directional as well as hedged exposures. We also show how you can allocate to over 20 hedge fund strategies to create custom exposures for your clients. So, let's get started. We are all very familiar with traditional investing in stocks, bond, and cash, as well as how to allocate to them. Alternative investing is a different ballgame, however, for it comes in many flavors. Hedge funds invest in equity and fixed income markets. They employ sophisticated trading strategies, use leverage, can short sell, and use derivative instruments. As we will see soon, there are over 20 different sub-strategies here. This is a pretty wide swath. It is important to make sense of this and provide appropriate exposures in changing market regimes to clients. It ain't easy. Fortunately, you have Active Allocator. There are many subtypes in the liquid space alone. It's rather messy, but probably a good thing on balance because correctly and carefully selecting from this universe helps build better portfolios. For example, we see here equity hedge funds that are exposed to a long-short portfolio of equities with a long bias. Event-driven funds, which specialize in trading around corporate events, such as M&A or corporate restructuring. Macro funds, who bet on directional movements in stocks, bonds, FX rates, and commodity prices. Relative value funds, which seek to profit from relative mispricing of related assets. Most of us, we suspect, wouldn't know what on earth to do with this menu of choices, which is where Active Allocator comes in handy. We have created a methodology that is complex, rigorous, and thoughtful, one that challenges traditional assumptions. We address unique alternative investment issues such as survivorship bias, serial correlation in returns, strategy drift, and non-normal historical returns distribution issues. We help you combine different hedge fund strategies, from the maze we just saw, to create exactly the type of directional exposure your clients need. Here, let us introduce the notion of market directionality as a way to simplify and frame this discourse. After all, exposure to market risks drive the bulk of hedge fund returns. By arbitraging a combination of market, credit, and liquidity risks, hedge funds are able to implement a wide variety of directional and non-directional strategies. For example, in equity investing directionality, the value of investments will fluctuate in response to general economic conditions and to changes in the prospects of particular companies and/or sectors in the economy. In fixed income investing directionality, the drivers are interest rate risk and credit risk. In mortgage-backed securities investing directionality, the drivers are prepayment risk and interest rates. In our framework, we are not prescriptive. You arrive at your own views on markets, the degree of directional exposure you may want to take or not take. What we do offer are ways to allocate to take on that exposure. Low directional strategy buckets tend to underperform long-based strategies in rising markets. They, however, overperform in falling markets. Their results more dependent on manager skills. They are generally more complex to implement. High directional baskets have much higher net long exposure to the broader market. Medium directional baskets lie in between. They focus on relative value arbitrage, fundamental investing, and distressed securities. Here you can see the general characteristics of the three baskets: returns, volatility, beta, degree of hedging, etc. Allocating to these baskets, and we will soon see what goes into them, provides your client such investment exposure characteristics. Here we split typical investors from very conservative to very aggressive, and suggest that very conservative investors are best off hedging themselves from market movements. They ought to invest in a low directionality bucket. And at the other end of the spectrum are the very aggressive investors who should split their allocation between medium and high directionality strategies. We also suggest a split for those in between. This is an example of bucketing different liquid alternatives in appropriate amounts to provide low, medium, and high directionality exposure. On the left-hand side, we have low directional strategies, such as equity market neutral. By definition, something that is neutral to markets. We also have M&A arbitrage, which does not depend on the market, and statistical arbitrage, which is a relative value trade. On extreme right, we see higher direction strategies such as long-short and global macro. The real devil, of course, is in the details. How does one arrive at appropriate allocations? Something we will see now. This here is really the heart of the matter, where we rigorously arrive at the constituents of the three baskets. To get here, we have adjusted hedge fund returns for serial correlation, survivorship bias, selection bias, illiquidity, and fees to arrive at their adjusted long-term statistical properties. Our allocation considerations include minimizing drawdowns, taking into account long-term beta effects, accounting for the distribution in historical returns, factoring in average loss and worst period returns. Another idea driving the optimizing is to carefully combine similar strategies to reduce the pernicious effects of style drift. And naturally, we go beyond traditional mean variance optimization, for extending modern portfolio theory to this domain just does not work. So here we see how investors can invest across 8 major sub-strategies to arrive at optimal levels of allocation customized to their particular preferences. To conclude, employing hedge funds, alternative mutual funds, and direct investments can be accretive to portfolios. The operative phrase, however, is, when done so properly. The good news is, you can use Active Allocator to take any type of exposure your clients want by selecting and combining strategies and manager funds. You can use it to provide guidance on portfolio construction, asset allocation, and fund selection to meet your clients' investment objectives. We encourage you to take a test drive, build a few model portfolios, and see how Active Allocator might be useful for your clients. Thank you for listening in.